Hey, you're tuned in to the Hustle Report by Profit Duel. Welcome back. Today, we're doing a deep dive, really boiling down a lot of research into, well, the essentials you need on alternative investing. Thinking of it as a serious side hustle strategy? Yeah, the mission here is pretty clear. You're looking to boost those returns, right? Get closer to financial independence, maybe faster. And you need a way past all the confusing stuff, the jargon that trips people up. So we're going straight to the core of it. What is alternative investing, or AI? What's the potential, and crucially, where are the pitfalls?
Right. So when we talk about alternative investing, we're specifically talking about moving beyond just, the standard stuff, stocks, bonds, mutual funds, the things most people think of first.
Yeah.
The main idea. It's about diversifying your portfolio, finding assets that don't just follow the stock market up and down.
Okay, let's unpack that right away.
Okay.
Unconventional assets. I mean, what exactly are we talking about? Because for most folks, investing is still, their 401k, maybe some index funds.
It's a pretty wide field, actually. But for someone looking at this as a serious side hustle, there may be four main areas that are more accessible. First, there's real estate, physical properties. Sometimes that's fractional ownership, or maybe through specific funds. It's pretty established.
Okay, real estate. Got it. Tangible. What's next?
Second, peer-to-peer lending, P2P. This is where you basically cut out the bank, connect your capital directly with borrowers.
Interesting. Directly connecting. Okay, number 3.
Third, well, cryptocurrencies. Highly volatile, obviously.
Yeah.
That whole decentralized digital asset world.
Right, the crypto space. Very different. And fourth?
And fourth, startups. So investing in early stage companies, you're putting money in, hoping for potentially massive growth if they really take off.
Wow, okay. That's quite a range. From, like you said, a physical building to a digital token you can't even touch. So how does this actually work then? How does it generate returns if it's not a typical job? It's not just throwing money at something and hoping, is it?
Oh, definitely not. No, the mechanism is really about strategic capital deployment. You're deciding to put a specific slice, often a smaller portion of your overall wealth, into these less conventional areas. And you're right, you're not earning an hourly wage. You're aiming for appreciation, maybe some passive yield over time.
So the strategy is different too.
Absolutely crucial point here. Because these assets aren't on the main regulated exchanges quite often, the core strategy isn't just clicking buy. It depends almost entirely on your own thorough research and due diligence. That's probably the biggest shift from traditional investing.
Yeah, I think that's a really key insight. People sometimes try to figure out the immediate payout, the hourly rate equivalent, but with alternative investing, that's not really the point, is it? You're playing a longer game.
Precisely. The focus is squarely on long-term returns and passive income, building wealth over years, not weeks. Now, some things, like P2P lending or rental properties, can generate regular income streams. But often, the main goal is asset appreciation, which means, yeah, you need a time commitment. You're building capital. You're not punching a clock.
Right, right. Building capital.
Yeah.
Okay, so knowing it's a longer game, money might be tied up. Why is this becoming so popular? Why are people moving towards these, let's face it, often riskier areas? What's the big promise here, the payoff?
Well, the potential for high returns is definitely part of the attraction, no doubt. But I'd say the biggest structural advantage is diversification. Think about it, if the main stock market takes a nosedive, having, say, 10 or 15% of your portfolio in something different like physical real estate or maybe a mix of early-stage companies, well, your entire net worth isn't just mimicking the S&P 500.
So it's a risk management thing, fundamentally.
It's huge for risk mitigation, yes.
Yeah.
It's absolutely paramount.
Okay, and then the returns themselves. You mentioned higher returns. In areas like startups, they could be well, explosive. Right?
That's the lure, definitely. The potential for higher returns. Investing really early in a company or finding a niche in real estate, you could see appreciation that you just won't find in large established companies. And for some assets, like maybe well-chosen rental properties or certain P2P loans, you can also get those steady passive income streams coming in alongside any potential appreciation.
Can you give an example of that passive income? What does that look like?
Sure. So we're talking about things like predictable rental income checks coming in each month from a property you own. Or with P2P lending, it's the interest payments that borrowers make on the loans you help fund through the platform.
Okay. So beyond the money side, the pure financials, there was another aspect that stood out in the research, this idea of personal choice, personal interest.
Yeah, absolutely. Alternative investing often opens doors to unique opportunities. You get to explore brand new industries, maybe cutting-edge technologies that just aren't listed on the public stock exchange yet. And that ties right into personal interest. Let's be honest, it's much easier to motivate yourself to do really deep research, that crucial due diligence, when you're genuinely interested in the area. Maybe it's sustainable businesses or AI tech or something else you're passionate about.
That passion is definitely going to be needed, though, when we flip the coin and look at the reality check. We've talked up the benefits, but,
Right.
well, high potential usually means high risk, right? Where does this get dangerous for someone trying this as a side hustle?
And this is where that deep dive, that research we mentioned, becomes so critical. We have to connect the promise to the potential peril. The first major risk is, well, the obvious one, higher risk of failure, particularly with things like startups. We have to be blunt. Many new ventures just don't make it. They fail. And that can mean losing all the capital you put in.
A total loss. Okay, that's stark. What else?
Well, perhaps the trickier challenge, especially for an individual investor, is the lack of liquidity. And this is where it gets really interesting and sometimes frustrating. See, you can sell shares of a big public company in seconds, right? But if you own a piece of a private building or equity in a startup, turning that back into cash takes time. Sometimes, honestly, months or even longer.
So your money isn't just invested long term. Your ability to get out is restricted. You're kind of stuck until you find a buyer.
Exactly. That's the sharp insight. You need to find a buyer willing to pay your price, and there isn't always a ready market waiting. That lack of liquidity means you might even have to sell at a big discount if you suddenly need the cash fast. That's a core risk, especially for a side hustler who might need that capital flexibility.
Okay, lack of liquidity, big one. What about just the unpredictable value swings? These aren't stable blue chip stocks.
Right, that leads straight into market volatility. The value of these alternative assets can swing dramatically. Crypto is the poster child for this, obviously. But even to say local real estate prices or the valuation of a private company can fluctuate wildly based on all sorts of factors. It makes predicting returns really, really difficult.
So predictability goes out the window.
Pretty much.
Yeah.
And tied to that is another major factor, limited regulation. Unlike the public stock markets, which have, the SEC and other bodies watching closely, the alternative space often operates with much less oversight. For you, the investor, that means it's way harder to judge how credible an opportunity is, how reliable the information is, what the real underlying value might be.
It sounds like that due diligence you mentioned earlier becomes basically your only safety net. There's no regulatory backstop in the same way.
It absolutely is. Your research is your shield. And to do that research effectively, to manage all these risks, the volatility, the liquidity issues, you really need specialized knowledge. We can't just apply a generic investment approach. Evaluating PDP loan risks is totally different from assessing a tech startup's market potential, which is different again from understanding local zoning laws for real estate. Each asset class demands its own expertise.
That feels like maybe the highest hurdle, doesn't it? Even more than the money sometimes. Just knowing enough to make smart choices. So, okay, putting it all together, if someone hears all this, accepts the risks, and they're ready to, roll up their sleeves and start digging, where do they actually begin? What are the practical first steps for this side hustle?
Well, the good news is platforms have emerged that make it easier to get started, lower the barrier to entry a bit. For real estate, for instance, our research often points to sites like Zillow and Redfin for market data and platforms like Roofstock that are specifically geared towards buying investment properties, sometimes even with tenants already in place, or fractional ownership platforms.
Okay, so tools exist for real estate. What about the others?
For peer-to-peer lending, if you want that cash flow, platforms like Lending Club and Prosper are the main players. They connect you, the lender, directly with borrowers.
Lending Club, Prosper, got it. Crypto.
Cryptocurrencies, yeah, that's through the major exchanges. You're looking at places like Coinbase or Binance as the main on-ramps for buying and selling digital assets.
And finally, startups, the really early stage stuff.
For startups, there are specialized platforms too. AngelList and Seed Invest are two well-known ones that basically let accredited investors browse and invest in early-stage companies seeking funding.
Okay, so having those platform names makes it feel much more concrete, less abstract. If you had to give one single piece of advice, the most critical takeaway for someone managing their first steps in this?
It comes up again and again, regardless of the asset class.
Okay.
Start small, really. Test the waters first. Dip your toe in, understand how that specific market works, how volatile it is, what the real risks feel like. Build your knowledge gradually. You should never, ever commit a large chunk of your capital to something volatile or illiquid until you're confident you understand its dynamics.
Absolutely crucial advice. Start small, learn as you go. Okay, so let's try to synthesize this. Alternative investing. It clearly offers these really exciting paths, right? Passive income, diversification you can't get elsewhere, maybe investing in things you're passionate about. But that opportunity demands serious trade-offs. You need that specialized knowledge we talked about, and you have to accept fundamentally higher risk and often much lower liquidity.
That trade-off really is the heart of it. It's the core tension in this kind of side hustle.
Hmm.
As you think about your long-term wealth strategy, you constantly have to ask yourself, what's the right balance for me?
Hmm.
How much easy access liquidity do I need versus how much can I lock up in potentially higher growth but illiquid and riskier assets? The answer isn't necessarily maximizing growth or liquidity. It's about finding your personal sweet spot between traditional accessible investments and these powerful but more demanding alternative options. And maybe think beyond just these specific alternative investments too. Consider exploring other potential income streams that fit your risk profile and interests. Things like matched betting, or maybe even day trading if you have the appetite and knowledge for it. There's a whole world of side hustles out there to build wealth.
That's a great thought to end on, finding that personal balance and maybe even broadening the horizon of what hustle means for you. It's all about fitting it to your goals and your comfort level with risk. That's it for this episode. Thanks for listening, and we'll see you next time.